Welcome to today's Explainer. We are diving headfirst into a company that is literally sitting right at the intersection of a massive global shift. I'm talking about Expand Energy, trading under the ticker symbol EXE. Right now, as you probably know, global energy demands are surging. We're seeing rapidly rising power demand, booming industrial activity, and quite frankly, a total reset in global energy security. So today, we're going to dig into the hard data to see exactly how Expand Energy's financial footing positions them in this highly volatile, high-stakes landscape. So, this brings us to the big, fundamental, macro question we really need to frame this entire explainer around. How exactly will the U.S. meet this rising global natural gas demand? You see, energy security has pushed U.S. natural gas to the absolute forefront. The world desperately needs a reliable, affordable, and lower carbon energy supply, and the infrastructure to actually deliver it is evolving incredibly fast. Keep this question in the back of your mind as we walk through the numbers today. Because that question, it leads us directly to the subject of our analysis. Expand Energy is currently North America's largest, low-cost, market-connected natural gas producer. They have built this incredible platform that's positioned perfectly within the U.S. market, specifically targeting that structural demand growth we just talked about. To really unpack all this data, we're going to follow a quick 5-part agenda today. 1, we'll meet Expand Energy. 2, we'll look at their financial health and valuation. 3, we'll check out the Wall Street analyst sentiment. 4, we'll dive into the LNG catalyst. And finally, number 5, shareholder returns. Okay, let's dive right into this. Section 1, Meet Expand Energy, America's natural gas giant. Just look at the massive scale of their Q1 2026 operations. They delivered a net production of roughly 7.44 billion cubic feet equivalent per day. To put that into perspective, that is enough energy to single-handedly power millions of homes, and 93% of that is natural gas. Operating 13 rigs and drilling 60 wells in just a single quarter is super impressive. But actually, the absolute critical data point here is that final one, a break-even price below $3. Having this industry-leading, low-cost inventory in the Haynesville and Appalachia regions is a real game-changer because it allows them to consistently grow free cash flow even when the broader market conditions fluctuate. Moving right along to Section 2, Financial Health and Valuation. Let's break down the actual numbers. Looking at their sheer earnings power, in the first quarter of 2026, Expand Energy generated a massive $1.968 billion in adjusted EBITDA. That metric factors in exploration expenses, so it gives us a much clearer picture of their core profitability. Add in the $2.402 billion in net cash provided by operating activities, and well, the picture is pretty clear. This isn't just about moving molecules around, it's about generating repeatable, reliable cash flow. And that brings us to their current valuation. We're looking at a company with a market cap of around $20.87 billion. But check out these ratios on the table. A trailing PE ratio of just 6.54 and an enterprise value to EBITDA ratio of 3.19. In a broader market where, let's face it, sky-high valuations are basically the norm right now, these numbers suggest a highly efficient cash-generating machine that's priced like a total bargain relative to its underlying earnings. Section 3. Wall Street analyst sentiment. Let's see what the consensus view is. The contrast in these projections is honestly pretty stark. As of July 2026, Expand Energy was trading roughly at $87.25 a share. However, the average price target from analysts sits significantly higher, way up at $127.08. That implies an upside consensus of nearly 45% from its current trading levels. Wall Street is clearly seeing a pretty massive disconnect between the current share price and the company's true intrinsic value. And you know, this isn't just one outlier analyst making a wild guess. We are seeing real authoritative credibility building up this bull case. Heavy-hitting firms like UBS and Truist Securities recently issued buy ratings with targets of $133. Barclays has an overweight rating with a $127 target. Out of 26 analysts surveyed, the overall consensus is a resounding buy. Which brings us to Section 4, the LNG catalyst, connecting to global markets. To really grasp their strategy, we have to look at the macro-environmental tailwinds. As interim CEO Mike Wicherich noted, and I quote, "The world critically needs natural gas supply to meet rapidly rising power demand, growing industrial activity, and global LNG expansion to address a global reset in energy security." Expand Energy's Gulf Coast assets sit right at the epicenter of this LNG expansion. In fact, their largest customers today are already LNG facilities. So, the crucial point here is exactly how they are executing on this vision. In April 2026, they went ahead and signed a massive 20-year sales and purchase agreement with Delfin LNG. Under this deal, Expand Energy will purchase roughly 1.15 million tons of LNG per year based on Henry Hub pricing, which is the official benchmark for U.S. natural gas. This means it isn't just about selling gas domestically anymore. It is about vertically integrating to connect their low-cost U.S. supply directly to premium global demand centers. All right, last but not least, Section 5, shareholder returns, dividends, and debt reduction. I really want to hit you with this first massive number, $1.3 billion. That is the amount of gross debt Expand Energy redeemed, just year to date by late April 2026. The company is aggressively utilizing its free cash flow to strengthen its balance sheet, which creates immense financial capacity and significantly lowers their overall risk. Now let's see how this builds into their equity strategy, because alongside that massive debt reduction, they immediately followed up by executing $150 million in share repurchases in that exact same timeframe. They're actively stepping in to buy their own stock, supporting the share price, and ultimately increasing the ownership stake for the remaining shareholders. And on top of the buybacks and the debt reduction, there is direct income potential for you. Expand Energy pays a quarterly base dividend of 57.5 cents per share. Annually, that's $3.19, which, against their current stock price, yields roughly 3.66%. So you have a company trading at a low multiple, aggressively paying down debt, buying back stock, and paying a solid, sustainable dividend yield to boot. Which really leaves us with this final provocative question, one that management actually echoed on their latest earnings call. Is Expand Energy built for this moment? Well, you've seen the data today. You've seen their below $3 break-even costs, their massive free cash flow, those strategic 20-year L&D agreements, and the nearly 45% upside projected by Wall Street. As global energy markets continue to evolve and demand for natural gas grows both domestically and abroad, you have to weigh this due diligence against the future. Are they positioned right where the puck is going? That's for you to decide. Thanks so much for joining me on this explainer, and keep learning.